Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Today we're talking about the best ETFs for 2019 and how to play what I think is going to be a volatile market going into Q1 of 2019 and moving forward. Stay tuned. So today we're talking about the best ETFs for 2019, but for the total beginners out there, what does an ETF even mean and why are there some advantages and disadvantages to trading these? So an ETF stands for Exchange Traded Fund. This is simply saying that the ETF contains a bunch of stocks within one stock. So the ETF itself is one stock, just like Apple, just like Nike, just like Ford. However, it contains a basket of stocks. So you're gaining a lot of exposure into a certain exchange or an index or whatever the fund is tracking, and a lot of exposure but only owning one stock, which kind of smooths out your risk and your volatility. So let's get right into it. My number one ETF for 2019 is the Healthcare Spider, ticker symbol XLV. So this is an ETF that seeks to provide an effective representation of the healthcare sector of the S&P 500. So these companies delve in pharmaceuticals, healthcare equipment and services, healthcare providers and supplies, biotechnology, life science tools and services, and healthcare technology. So this ETF actually has $19.15 billion of assets under management, and it holds a total of 62 holdings. So its top 10 holdings are Johnson & Johnson, Pfizer, United Health Group Incorporated, Merck & Company, AbbVie, Medtronic, Abbott Laboratories, Amgen, Eli Lilly, Thermo Fisher Scientific, and you can see all those right here, and also the percentages show you what portion of the assets these companies make up. So the fund industry allocation based on this screenshot right here, you can see exactly how much of this ETF contains within each sort of industry within this fund, if that makes sense. So you can see that it has about 33.6% in pharmaceuticals, 21% in healthcare equipment and supplies, 21% of healthcare providers and services, 16% in biotech, 6% in life science tools and services, and about 52 basis points of healthcare technology. The one-year performance for this spider has been about negative 30 basis points. The 5-year performance has been about 52.2%, and the expense ratio is actually about 13 basis points. So it's important to understand what an expense ratio is when making any financial decisions. These apply to mutual funds, actively managed hedge funds. These are pretty much how the company that creates these ETFs gets paid and how the management gets paid as well. So for about every $1,000 that you have invested in this, management is taking about $13 in fees. That's where that 0.13% comes from. Some of the pros of this ETF are that it dominates the U.S. healthcare sector in every imaginable measure, and it's also the oldest and largest fund in the sector. A few of the cons are that politics can definitely play a role in how healthcare performs, especially with everything that's going on with the modifications to Obamacare and the Affordable Care Act. But in conclusion, this is definitely a safe ETF with exposure to a lot of solid companies that aren't going anywhere anytime soon. So the second ETF for the best ETFs of 2019, in my opinion, is Vanguard Financial's ticker symbol VFH. So this is an ETF designed to track the performance of the MSCI US Investable Market Financials 2550 Index. This essentially includes the top 98% of companies in terms of market cap. So it's pretty much your top 98% biggest financial companies that are publicly traded in the United States. So the assets under management for this ETF is $6.42 billion, and it has a total number of holdings of 418. Yes, you heard that right. That is 418 holdings compared to just 62 of the healthcare spider that I just showed you. So its top 10 holdings are JP Morgan Chase, Berkshire Hathaway, Bank of America, Wells Fargo, Citigroup, US Bancorp, American Express, Goldman Sachs, CME Group, and PNC Financial. So if you take a look at the sector breakdown, you can see that about 52% are in banking services, 26% are in insurance, 17% are investment banking and investment services, and then the rest are pretty minuscule from here. So the 1-year performance is actually negative 18.95%, which I'm a little bit surprised about. I thought that all the interest rate hikes and Trump becoming president would actually help this a lot more than it has. However, the 5-year performance is actually right around 30.5%. The expense ratio for this ETF is a little bit lower. It's actually 10 basis points. So essentially every $1,000 that you have invested, you're paying about $10 in fees. Some of the pros of this ETF are that it has low fees and broad diversification. And then also some of the cons are actually an economic slowdown may stagnate this ETF moving forward. So I know I mentioned that this is kind of the way to play this upcoming market, but you know, an economic slowdown pretty much affects everything. It's kind of like a high tide raises all ships, a low tide lowers all ships. So that's something to take into consideration for this one. In conclusion, I think that poor annual performance that we saw just now, coupled with rising interest rate environment, lends this to be a good opportunity for the long term, starting in 2019. So finally, the third ETF for 2019 is the Utilities Select Sector SPDR with ticker symbol XLU. So this is an ETF designed to track a market cap weighted index of U.S. utility stocks drawn exclusively from the S&P 500. So the assets under management that you see here are $8.69 billion, and it only has a total number of holdings of 30. Its top 10 holdings are NextEra Energy, Duke Energy Corporation, Dominion Energy, Southern Company, Exelon Corporation, American Electric, Sempra Energy, Public Service, Xcel Energy, and Consolidated Edison. You can see here that in terms of the sector or industry breakdown, it's very heavy in the electric utilities at about 82.68%. And then also the multi-line utilities are 15%, with only about 2% in the water utilities. So the 1-year performance for this ETF has been about 3.2%, and the 5-year has been about 46%. The nice thing about this ETF is that it has a nice fat dividend yield at 3.46% at the time of this recording, and its expense ratio is 13 basis points, 0.13%. So again, for about every $1,000 that you have invested into this ETF, you're paying about $13 in fees. Some of the biggest pros are that the fund dominates its segment, and then the cons are that it's more concentrated in a handful of large firms. So in conclusion, again, this is a solid ETF to weather the storm of what seems to be an impending bear market. So there you have it, everybody. Those are my best ETFs for 2019 and moving forward. Nothing fancy, nothing pretty, nothing super high risk. You can see here that some of the financials ETFs did not do well last year, and the other two kind of did just okay. So hopefully these ETFs will weather the storm of what I think will be an impending downturn in 2019. How much of a correction it's going to be in 2019, we'll see, but I think it's definitely going to be stagnant. So ultimately, I hope you guys got value out of this video. If you did, please click the subscribe button below if you haven't already. And also check out my private stock market membership group, The Informed Investor. There is a ton of value there, and I'll let the sales page talk for itself. I don't want to take up any more of your time. If you got value from this video, send this video to one friend. I would greatly appreciate it. Thank you so much and have a prosperous day. We don't take no L.